Welcome everybody to our last lecture. It's about sustainable fiscal and monetary policy with Maria Nikolaidi. And I will shortly introduce our group to you. And then afterwards, Maria Nikolaidi will have a talk, and afterwards there will be a discussion. Okay. This is our group. We are Rethinking Economics Kiel. We have organized this lecture series, and we welcome everybody of you who are interested in these kind of topics, like in this lecture series, to come to our group and organize the next lecture series or other kinds of events. This photo was taken in the summer, and we organized a poetry slam on sustainable economic policies. So we invite you to come to us, and it's really fun to do this kind of work. We are part of the network Rethinking Economics, and this is all over the world. Like, there are some places in the US or even in Australia. So it's a big movement, and you can be part of this kind of movement. In Germany, we are part of the Netzwerk Pluralist, which was founded in 2008, and there are now 34 active local groups at every university, or like there are 500 members, and we are organized via the internet, via Basecamp, and there you can find a lot of information and other interesting people. We are organized in our group in teams, or like in groups. There's one reading circle, and we have read these 3 books. And now we are discussing economist articles, and you can join the reading circle every Wednesday, and you only have to write us an email. There are some recordings already on YouTube. There was a lecture series in the summer, and now we are recording this lecture series in the winter. And we are now looking for some new possibilities to organize the next lecture series in the next summer semesters. We are also part of the convention of the Faculty of Economics and Social Science. There are 2 seats in the convention, and we are happy to decide on professorships at the faculty with the other members of the conventions, and it's also a very interesting job to do. And now I can introduce Maria Nikolaidi. She is associate professor in economics in Greenwich. Her research is basically on financial fragility, macroeconomic policy, or ecological macroeconomics and bank regulations. And she is fellow of the Forum for Macroeconomics and Macroeconomic Policies. And she is member of the committee in Post-Keynesian Economic Society of the, Post-Keynesian Economic Society. And now she will talk on sustainable fiscal and monetary policy. I will hand over to you, Maria.
Many thanks. Let me share my screen. Yeah. Okay. Hopefully you can see my screen. First of all, many thanks for the introduction, and many thanks for the invitation. The initiative that we have to organize this lecture series is great. So as you said in my talk, I'm going to focus on green fiscal policies and green monetary policies. And I'm also going to combine these type of policies with other policies like green financial policies and change in consumption patterns. So as we all know, there is an urgent need to decarbonize our economies as fast as possible. We know that according to the Paris Agreement, we need to avoid increasing the atmospheric temperature more than 1.5 degrees. However, we also know that we are very far for achieving this target. Climate macroeconomic policies can be used in order to support the target of the Paris Agreement. These macroeconomic policies could be green fiscal policies, such as carbon taxes, green public investment, or green subsidies. It could be also green monetary policies, such as green QE, the green quantitative easing, as we say. In my presentation, I'm going to focus on two specific questions. So you can see them on the slide. The first one is that I want to evaluate how these macroeconomic policies could be used. So I'm going to evaluate these policies from a modeling perspective. And the second one is, and I'm going to talk briefly about that, I want to discuss what are the political barriers to the implementation of these policies. So first of all, let me start with some key differences between different approaches that we have on modeling in order to investigate these climate policies. I have two broad categories. The first category refers to the mainstream environmental models. Usually these are the so-called integrated assessment models, the CG, computable general equilibrium models, and the DSG, dynamic stochastic general equilibrium models. We also have another group of models that refer to post-Keynesian ecological models, and this refers not only to the stock flow ecosystem models that I will focus on my presentation, but also to some post-Keynesian age-based models. So let me identify some of the key differences between these two different groups of models. So in the mainstream environmental models, we have that demand does not play an important role. We have that output is supply determined. So usually output is a kind of a function of capital and labor. However, this is not the case in post-Keynesian ecological models, in which case output is demand determined. There are some cases, some models in which supply side constraints might arise as well. We need to understand that within the mainstream environmental models, mitigation expenditure is considered only as a cost. When we talk about mitigation expenditure, we refer to expenditure that firms have to make in order to reduce their emissions. Obviously, this is a cost for them, but we need to understand that if we have a cost, this is an outflow for some firms in the economy. This, at the same time, is an inflow for someone else in the economy. So this is something that is taken into account within these post-Keynesian ecological models. So mitigation expenditure is both considered not only as a cost, but also as an inflow of income. So as a result, both the positive and negative effects are taken into account when we implement this mitigation expenditure. And this is important for the way that the growth rate of output is going to evolve. Within the DSG, CG, and the integrated assessment models, we have that money is not endogenous, so money is exogenous. So we have banks that just use prior savings in order to finance investment. However, in post-Keynesian models, we have that money is endogenous. This is important because the role of the financial system is important in order to determine economic activity. So banks can provide even more loans and can increase lending, investment, and consumption correspondingly. Now, how about the way through which agents take their decisions? Within the mainstream environmental models, usually there is a maximization. So firms want to maximize their profits, while households want to maximize their utility. Post-Keynesian ecological models, we don't have something like that. We have what we call heuristics, and this is linked with fundamental uncertainty. In this case, agents, firms, or households want to follow a specific norm. So, for example, firms might not want to take more debt to income than a threshold that they have taken into account. Lastly, I would like to point out that within these mainstream environmental models, all these type of problems, environmental problems, are considered as externalities. This is important because in these models, when you apply a price, like a carbon price, you are able to solve the problem. However, this is more complex within the post-Keynesian ecological models. This is because we have a more systems-based approach, and we realize that when we talk about the economy is a subsystem of the ecosystem. So we have more complex interactions between the ecosystem, the macroeconomy, and the financial system as well. So if we apply only a price, a carbon tax, the problem might not be solved. So other issues need to be taken into account as well. So these are some of the key differences between the mainstream models and the post-Keynesian ecological models. I would also like to investigate another key difference between these two different models, and this has to do with the way that we make a policy analysis. When we use the mainstream approach, the mainstream modeling approach in order to analyze, in order to evaluate policies, usually we want to find the optimal policies. How are we going to do that? Within the mainstream environmental models, we use this cost and benefit analysis. Always we have a cost. This is linked with the mitigation expenditure that I mentioned before. So firms have to pay something, but at the same time, there is a bit of a benefit because there will be less emissions in the economy and less damages. So within the mainstream approach, we take into account this cost benefit analysis. I have an example of Nordhaus on the slide. As you remember, Nordhaus has won a Nobel, and he shows that when we implement these optimal policies and we implement a specific carbon tax, which is in line with this cost-benefit analysis, in reality, we will end up with atmospheric temperature at the end of the century that is close to 3.5 degrees. So obviously, this is not in line with the Paris Agreement targets. However, in post-Keynesian ecological models, it doesn't mean that we will use this cost-benefit analysis. We will not rely only on one measure in order to evaluate these policies. And usually in these mainstream environmental models, the social planner wants to maximize their welfare. Instead, in post-Keynesian ecological models, we use different ratios, different measures in order to evaluate these policies. And obviously, these measures might refer to different parts of the economy, of the ecosystem, and the financial system as well. So I have identified some of these indicators. This could be the unemployment rate in the economy, obviously emissions or waste, are some indicators that refer to the ecosystem and are important, and we need to take them into account. But also the financial system is important as well, and we might want to avoid an increasing financial fragility. So this financial fragility might be linked with the indebtedness of the households or the indebtedness of the firm sector. So what I'm saying is that within the post-Keynesian ecological models, we need to understand that when we implement policies, the climate macroeconomic policies that I mentioned at the beginning, obviously we have trade-offs, and we need to identify these trade-offs and then choose this policy that we want to implement based on policy priorities. Now I would like to focus on the model that I have co-developed. The model is called DEFINE. DEFINE stands for this dynamic ecosystem finance economy. It's a model that I have co-developed with Yannis Dafermos and Yorgos Galanis. This is one of the first models that has been developed that shows these interactions between the macroeconomy and the ecosystem, but also pays particular attention to the role of the financial sector. We have some papers, some of them have appeared in ecological economics and general financial stability. And in these papers, we try to analyze and evaluate the implementation of various policies. First of all, I need to clarify that this is a model that refers to the global economy. we first develop a baseline scenario. So a simulation starts in 2018. In this baseline scenario, we take into account the IPCC, the Intergovernmental Panel of Climate Change Scenarios. So in our baseline scenario, we have a transition to a low carbon economy, but this transition is very low. As a result, we want to implement various climate policies in order to check if we can achieve this target set by the Paris Agreement. We have prepared a website in which we have provided more details about the detail of the model, not only with the publications, also we have a manual, the code of the model is available as well. And we also have a web interface in case you are interested to understand a bit the way that the model works. So now I would like to talk a little bit more about this defined model, which is a post-Keynesian ecological macroeconomic model, just to give you a bit of an overview of the structure of the model. So the model has these two large blocks. The one block refers to the ecosystem, the other one refers to the macroeconomy, which includes obviously the financial system in our case. These two blocks has its own sub-blocks. So in the ecosystem, we pay particular attention to matter and energy that needs to be used in order to produce goods. Obviously, we have a separate module that shows the amount of emissions that we produce in the economy, and this is linked with atmospheric temperature as well. We have another module that pays attention to ecological efficiency indicators. So we have indicators for share of renewable energy, recycling as well. Within the macroeconomy, we have the sectors that you can see on the slide. So we have firms that take out loans in order to finance their investment, and these loans are taken by banks. We also have that firms can issue bonds, both conventional bonds and green bonds, in order to finance their expenditure. And these bonds can be bought by households or by central banks. Okay, so this is the basic structure of the defined model. Since it is a post-Keynesian model, money is obviously endogenous. We take into account that output is demand determined, but in our model we take into account that supply constraints might arise as well. And we pay particular attention to the interaction between the macroeconomy and the ecosystem. In order to do that in a consistent way, I will use 4 different matrices. So I'm not sure if you are aware, but when we talk about this post-Keynesian stock flow consistent models, we usually use 2 traditional matrices. This is the balancing matrix and the transaction flow matrix. So these matrices are being used in order to incorporate in a consistent way the assets and the liabilities and the inflows and outflows in the economy. The balancing matrix that you can see on the slide shows the financial assets and financial liabilities for the different sectors that I mentioned before. So as you can see, we have household firms, commercial banks, the government, and the central banks that I mentioned before. This table can be used in order to identify budget constraints. So from the column that I have identified, highlighted with red, we can evaluate, we can find the value of capital that banks hold. And as we know, the amount of capital that commercial banks need to hold is equal to the assets, loans, for example, securities, minus the liabilities, minus deposits and advances in our example. So in this way, we make sure that we incorporate stocks in a consistent way. The transaction flow matrix is a bit more complicated, so this is why I have not included, but it's very useful in order to incorporate all these assets and liabilities, inflows and outflows in a consistent way and avoid black holes, as we say. So the balancing matrix and the transaction flow matrix, as I said, was the standard matrices that we use in post-Keynesian stock flow consistent models. For our model, we have also used two additional matrices that refer to physical stocks and flows. On the slide, you can see the physical flow, and this refers obviously to matter and energy. So we take into account that when we want to produce goods, obviously matter and energy needs to be used along with oxygen, but at the same time you have a production of output, but we need to take into account that emissions are also produced and waste as well. So in this way, we take into account both the first and the second law of thermodynamics that refers to matter and the energy balance. When we combine these, all these four matrices that I have mentioned so far, we are able to take into account the work of Godfrey-Lavoie that have done on post-Keynesian stock flow consistent models, and take into account also the work of Georgescu-Roegi. Happy obviously to discuss more about this issue later at the Q&A session. Now I would like to focus on some of the policies that I would like to evaluate. So I will start with the green fiscal policies, then with the green monetary policies, green regulatory policies, and then I'll give you a kind of a combination of various climate macroeconomic policies. So on the slide, you can see that I have highlighted three different green fiscal policies. I suppose most of you are familiar with the carbon taxes. That's the idea when firms have to pay for the carbon emissions. And as a result, they are induced to reduce their emissions, and probably they can invest in green capital. So we assume at a specific year in 2022 that there is an increase in the carbon tax, which is in line with this shared socioeconomic pathway 3 that we have. In the second scenario, we combine carbon taxes with green subsidies. So I have already mentioned what carbon taxes are. I suppose you know that when we talk about green subsidies, this is when firms can receive money from the government in order to fund their green investment. In our scenario, we want to investigate what happens if these carbon taxes are being used in order to finance these green subsidies. So this is what we call the recycling of revenues. And the last policy that I would like to show you, I refer to green fiscal policies, is the green public investment. So this is the case in which the government would produce more electric buses, would have generally more low carbon transportation. So in our simulations, we assume that the green investment could become higher from 0.2% as a percentage of GDP to 1%. So let me show you some of our simulation results. Hopefully it's not so complicated. I have on the slide two different figures, sorry. This refers to the growth rate of output and default rate. And I will focus on these three policies that I mentioned before. First, you need to see what is happening at the baseline scenario. So the black line, for example, here shows the growth rate of output in our baseline scenario. In the first years, you can see that this is the effect of COVID that we have right now. So this is why we have initially this drop in economic activity. After that, in 2022, as I said before, we implement separately the policies that I mentioned before. So when we implement only carbon taxes, this is this green line. As you can see, the growth rate of output becomes lower compared to the baseline scenario. So this shows that obviously economic activity becomes lower. This is because firms have to pay taxes. And as you know, when firms have to pay taxes, this affects adversely their profitability. When they have less profits, they are less able to make investment. So as a result, we can see that investment gradually becomes lower and economic activity gradually becomes lower as well. As you can see, there is kind of a turning point. This is a point in which firms have already invested in green capital, and as a result, they have reduced their emissions and they are able to pay less carbon taxes because they have less emissions. So there is a bit of a cyclicality here when we implement only carbon taxes. Can we avoid that? Yes, we can if we combine carbon taxes with green subsidies. And you can see that with this orange line. So you can see this orange line is pretty much the same, especially at the beginning, as in the baseline scenario. So when we have this recycling of revenues, we are able to avoid this type of recession, let's say, in the first years, and this cyclicality. When we implement only the green public investment, we have an increase in the growth rate of output. Obviously, this is because green public investment directly affects output. And obviously, we have a multiplier effects as well. So this increase in green public investment allows firms to have more sales. They can increase furthermore their investment, consumption, and so on. Now, these are the results for the growth rate of output. What's happening with the rate of default? The rate of default, first of all, is the ability of the firms to repay their loans. Obviously, these taxes affect their ability to repay their loans. Carbon taxes, as you can see with this green line, increases the rate of default compared to the baseline, which is in line with what we call the climate Minsky moment, since firms are less able to repay the loans because they have less profits. This is not the case with a combination of carbon taxes and green subsidies. And when we implement only the green public investment, in reality, we have a lower rate of default because firms end up having more profits. Now, the key question when we implement this type of green fiscal policies is what is happening with the sustainability of the debt for the government sector. So this is why I have included on the slide this public debt to GDP. Let me focus on the carbon tax first. As you can, theoretically, when we implement only carbon taxes, we expect that the debt to GDP of the government will go down. Why? Because the government is going to collect more taxes. While when we implement only the green public investment, we expect an increase of the public debt to GDP. However, this is not what we get in our simulations. In particular, let's start with the carbon taxes. We have at the beginning that the government is able to reduce its deficit, but at the same time, when we want to evaluate the debt to GDP, we need to understand what are the effects of carbon taxes on output. And as I said before, output becomes less. So overall, the debt to GDP ratio becomes higher. This is because the decline of the GDP overcompensates this decline of public debt. When we implement together the carbon taxes and green subsidies, we don't have a change of the public debt, especially at the beginning. And when we have only the green public investment, in our simulations, we get that the public debt to GDP becomes lower. So when we have an increase in public expenditure, we don't have any concerns about the public debt to GDP. This is because GDP increases even more than the increase of public debt. The key question is not only about macroeconomic indicators, it's also important to understand what's happening with atmospheric temperature. We have a graph here for the atmospheric temperature, and individually you can see that these type of policies can reduce atmospheric temperature and becomes lower compared to the baseline scenario. But as you can see, each one of them cannot reach on its own that 1.5 degrees Celsius that I mentioned at the beginning of the lecture. Now, can we evaluate these policies in a coherent way? In order to have this evaluation, I have identified the various indicators in 3 different groups. The first one is, the first category refers, let's say, financial indicators, the other one to the macroeconomy and social aspects, and the last one, obviously, to environmental issues as well. The financial indicators not only have to do with the rate of default and the indebtedness of the public sector, have also included another indicator which refers to the leverage ratio of banks. This shows the financial fragility of the banking sector. When this is high, it means that banks are more fragile. The other indicators for the macroeconomy, it's not only the unemployment rate, and as you can see, I have focused on the unemployment rate and not on the growth rate of output. We have also the wage share, which shows the functional income distribution. The ecological indicators shouldn't be only about atmospheric temperature. This is why we have included this material use and waste indicator. I have highlighted with green whatever is good, doesn't contribute to a problem when a policy is implemented. I have highlighted with red if a problem arises because we implement this policy. And when we have this orange, it means that a problem might arise and we need to look into that. And as you can see, I have both what's happening at the short term and long term. When we implement only carbon taxes, as you can see, both in the short term and long term, we have problems, not only because of an increase in the unemployment rate, and at the same time, we have a decline in the wage, which shows that the functional income distribution becomes worse, but also that the leverage ratio of banks becomes worse. So the financial fragility of the banking sector is also of a concern. But overall, we can see that atmospheric temperature declines. When we combine carbon taxes and green subsidies, as you can see, all the problems that I mentioned before generally are resolved. And when we implement only the green public investment, we don't have the problems, especially with the unemployment rate. In reality, we have a decline in the unemployment rate because of this more economic activity that I mentioned before, especially in the long term. But we need to take into account that when we use more green public investment, it means that we need to use more resources, and we have a limited amount of resources to use. So this is why we have highlighted that at the end of our simulations, there are some problems with regard to the material used and the waste per capita. So these are some trade-offs when we implement some of the green fiscal policies that I mentioned before. On this slide, I have identified some other green monetary and financial policies. The first two policies refer to the regulatory system, and the last one, the green QE, to the monetary to central banks. So let me start with the first two. I'm not sure that you know that, but probably you are familiar with that. When we talk about banks, usually banks don't want to hold a lot of capital. Why? Because this is very costly, okay? So this is taken into account when we implement, or we can implement, the dirty penalizing factor and the green supporting factor. So the idea of the dirty penalizing factor is to ask banks to hold more capital when they provide dirty loans, so loans that are provided to fossil fuel firms, for example. So when we implement the dirty penalizing factor, the idea is to induce banks to hold more capital, and as a result, they might be less willing to provide loans to dirty sectors such as fossil fuel companies. The idea of the green supporting factor is that banks can hold less capital when they provide loans to green, let's say, sectors that are linked with environmental friendly activities. As a result, they might be used to provide these more green loans, and they might be able to increase their green investment. The green QE, as I said, is linked with central banks. I'm sure that all of you are familiar with the idea of the QE with quantitative easing. You know that the central banks can buy different types of bonds. So these bonds could be corporate bonds or government bonds. The idea of the green QE is that central banks, instead of buying any type of bond, they can buy green bonds. So in our simulations, we check what's happening if central banks around the world purchase more green bonds, particularly 40% of the outstanding green bonds. Again, I have some figures to show you some of our simulation results. Let me start with the capital adequacy ratio. This is another indicator that shows the stability of the banking sector. It's equal to capital divided by risk-weighted assets. When we focus only on the dirty penalizing factor, this is the green line, you can see that the capital adequacy ratio becomes lower. As a result, in our simulations, we get that firms are less willing to provide dirty loans. So we have a less conventional investment. as a result of the decision of the banks. When we implement a green supporting factor, you might be able to see that there is a small increase in the capital adequacy ratio compared to the baseline scenario, and this enables banks to provide more green loans. In order to understand the implications of the green QE, we need to focus on the yield on green bonds. I'm sure that you know that when we talk about bonds and when we talk about central banks buying bonds, it means that there is more demand for this type of bonds. If the supply does not react a lot, there is an increase in the price of these bonds, and the yield is inversely linked with that. So this is why we have this reduction in the yield on green bonds when we implement only the green QE. This is important for our simulations and for our model, because this shows that firms are able to use more green bonds because they cost less. So instead of using green loans, they could instead issue more green bonds at a lower cost. Again, we want to understand the implications of these policies on the growth rate of output. You might expect that when we implement a debt penalizing factor, we have this reduction in the growth rate of output. And as you can see, this substantial reduction in the growth rate of output, a relatively substantial reduction in the growth rate of output. This is because banks provide less loans to fossil fuel companies, for example. And we know that fossil fuel companies consist of a large part of our economy, and generally carbon-intensive firms are a large part of our economy. When we focus on the green supporting factor, this is this orange line, you might be able to see that there is a small increase in the growth rate of output. This is not only the case for the green supporting factor, also for the green QE. So when we implement the green supporting factor and the green QE, we have a small increase in the growth rate of output because more green bonds, more green loans are used in order to finance investment. Overall atmospheric temperature becomes lower compared to the baseline scenario, but as you can see, there are not huge changes in atmospheric temperature. So on their own, these monetary and financial policies cannot deal with the problem that we have with climate change. Again, I want to evaluate these policies that I just discussed, and I have used exactly the same indicators as before. And I have identified if we have any problems. If you look at the green supportive factor and the green quantitative easing, you can see that generally there are no problems with the indicators that I have identified. There is only an increase in the leverage ratio of banks when we implement the green supportive factor. This is because banks need to hold or can hold less capital with the implementation of the green supporting factor. So it means that they are more fragile. We don't have something like that when we implement only the debt penalizing factor. In reality, banks are more stable because they hold more capital. However, we have other problems, and this is basically because of this decline in the economic activity. So we have at the same time more unemployment rate and an increase in the default rate. At the same time, also indebtedness of the government sector becomes higher. This is because of the lower economic activity. These problems persist only in the short term, and they generally are solved to some extent in the long term. So I have focused on green fiscal policies, on green monetary policies. I have shown you some results and the effects that they can have on the macroeconomy, the financial system, on atmospheric temperature, obviously. But then I would like also to just discuss very briefly some other type of policies, macroeconomic policies or initiatives that could be implemented. So the first one is what we call the transition to sufficiency. So this is linked with the change in consumption patterns. So in this simulation, we investigate what will happen if there is a gradual decline in consumption starting from 2022. At the same time, because we recognize that this decline in consumption pattern, which obviously is linked with the change in consumption patterns that we have, might increase the unemployment rate. So this is why at the same time, we reduce working hours in order to deal with the problem of unemployment. Then we have other two policies that are generally similar. They refer to energy regulation. So I suppose that there is the government, and they make an announcement now in 2022, and they announce that in 2030 they are going to stop using type of capital, in particular the energy capital, is being used by mining and utilities sectors. So this might bring kind of stranded assets. Okay? The basic difference between these two different simulations, these two different scenarios, is that in the energy regulation, no forward-looking scenario, the announcement is not credible by the firms. So in reality, firms don't do nothing until 2030. However, in the other scenario, we have that firms believe the announcement, and this is what we call a forward-looking scenario. Okay, so again, I have some figures just to show you how these climate policies can affect the growth rate of output. If we focus on the reduction in consumption and in working hours, this is this green line, you can see that there is a significant drop in economic activity. So this is obviously because people gradually reduce their consumption as time passes. Obviously, this affects as well the sales of the firm sector. So firms gradually end up making less and less investment. So this is why we have a gradual drop of the growth rate of output. When we implement the energy regulation scenario, in which it's not in which firms are not convinced about this policy, it means that in 2030, in particular the previous year before 2030, firms realize that the next year the government is going to make them not use the energy capital that they have. So they try to increase their green capital in order to make sure that they will be able to make investment. So this is why you have this huge increase in the growth rate of output at the beginning. But the next year, I will have, as I said before, the so-called stranded assets. So these stranded assets leads to an increase in the depreciation of the capital. This reduces the profitability of the firm sector and overall their investment. So this is why we have this huge drop of the growth rate of output. Someone could say that it's a bit comparable with what we had with COVID. But gradually firms are able to increase their green investment, and economic activity gradually becomes higher. All these problems are avoided. This type of transition is avoided when the policies are forward-looking. So in this case, this is the blue line. You can see that firms, when they hear the announcement, they start building green capital. They make investment in green capital. And as a result, they are able to avoid this large transition period. I've got to say that in the reduction in the consumption patterns, the reduction in consumption, we also reduce the working hours, and this is what I saw on this figure. And obviously, this affects the wage income of the households respectively. Before looking a little bit at the atmospheric temperature, I would like also to discuss briefly about the effects of these policies on the rate of profit of the firm sector. So usually there is a lot of discussion when we talk about these changing consumption patterns, how this can affect the profitability of the firms. And as you can expect, the profitability gradually becomes less. Something similar is happening with the energy regulation scenario, which is no forward looking. There is a huge drop in the rate of profit of the firm sector, which can be avoided if the policy is convincing to the firm sector. Atmospheric temperature generally declines a lot, someone could say, and it's not close to 1.5 degrees Celsius, but as you can see, they are quite effective. Again, I have evaluated these policies And as you can see in each of these policies, many issues arise, both in the short term and the long term. When we have only the changing consumption patterns, not only the unemployment rate increases and the functional income distribution worsens in the short term, but also we have an increase in the inability of the firms to repay their loans. The problems with the unemployment rate and the wage share are resolved basically because of this decline in the working hours, but we are not able to resolve the financial stability issues regard to the financial sector, and still we have some problems with public indebtedness. Of course, it doesn't mean that we need to care about the public debt to GDP ratio, but this is an indicator that usually is taken into account. I can discuss a little bit about that later. If we implement the regulation policies that are not forward-looking, we have some similar problems that are partially being resolved in the long term, but most of these problems, or some of these problems, are resolved if these policies are forward-looking. So I'm not sure if I have a lot of time. Just give me 5 minutes or so, and I will focus with these policy mixes and then with the conclusion that I have. A crucial question that arises is what can we do if we combine this type of policies? And we combine green fiscal policies with green financial policies and these changing consumption patterns that I mentioned before. So this is why we have 3 different types of policy mixes. The first one is a combination of these changing consumption patterns and with a reduction in working hours with the regulation policy, which is forward-looking. Then in the second scenario, we combine this with fiscal policies. So it's both carbon taxes, takes into account the recycling with carbon subsidies, and on top of it, the third one is green public investment. The third one is that we add the green supporting factor, the dirty penalizing factor, and the green QE. So we want to understand whether we are able to achieve the decline in atmospheric temperature close to 1.5 degrees Celsius, and what are the trade-offs that might arise. I'll be very brief here. I just wanted to identify that obviously when we talk about the growth rate of output, when we implement only these changing consumption patterns and regulation, initially we have a small increase in the growth rate of output. This is basically because of the regulation policy, but still we have this reduction in economic activity. We can avoid partially this when we combine it with green fiscal policies, but as you can see, the green financial policies can increase a bit the growth rate of output, but not so much. Again, when we implement only regulation and sufficiency policies, the rate of default increases even more compared to the baseline scenario. When we combine it with fiscal and financial policies, is a bit better, especially in the short term. Another indicator that I have briefly mentioned was the waste per capita. So I just wanted to show you what's happening when we use this type of combination of policies. As you can see, when we have this change in consumption pattern in the regulation, we have less resources that are being used, obviously because we have less consumption, and as a result, we have less waste. On top of it, we have a lot of green investment, and there is also recycling. So this is why basically we have this reduction in the waste per capita. And when we combine it with fiscal and financial policies, this reduction in waste per capita is even large. The atmospheric temperature, as you can see, declines, obviously compared to the baseline scenario. And when we put together all of the policies, the regulation, sufficiency, fiscal, and financial policies, were able to achieve this 1.5 degrees Celsius. As you can see, on their own, regulation, sufficiency, policy have an important effect on reducing atmospheric temperature, but at the same time, fiscal policy has an equally important role. Financial policies, not so much. So again, I have made this evaluation, and as you expect, when we have these regulation sufficiency policies, still we have many problems even in the long term. But when we implement fiscal policies, when we combine them with fiscal policy, some of these problems are partially resolved. Again, there are some issues with the financial fragility of the banking sector. If we have on top of it financial policies, generally we get some similar results. That's the last slide that I would like to share with you, and then we can have a Q&A session for any questions that you might have. I just show you different type of policies, climate macroeconomic policies that could be used in order to achieve or at least reduce atmospheric temperature within the next decades. Of course, then the problem is why don't we implement this type of policies? So I want a little bit to talk about these political barriers that we have when we implement when we want to implement these policies. So let me start with the green public investment. As you know, green public investment nowadays is relatively small. It's not huge. This is basically because various governments around the world are in line with what we call the public debt obsession. Countries in the global south, also countries, governments in the global south, such as the Eurozone countries, have this public debt obsession. We know right now that Eurozone countries have spent a lot because of COVID-19, and they might be asked in the next years to reduce their public expenditure in order to avoid the huge increase in public debt. And obviously, this is linked with this austerity dogma that we have. So basically, because we have this public debt obsession, it's not governments do not want to increase the green public investment because it will further increase the public debt. Another problem is when we want to implement these decarbonized monetary policies that I mentioned. So I particularly talked about this green quantitative easing. You know that central banks around the world, especially the ones in the global north, have a central bank mandates that refer to price stability or financial stability. So over the last years, there was a lot of discussion whether climate change can affect the central bank mandates. And there is a bit of an agreement that yes, indeed, climate change can affect price and financial stability. So far, various central banks, especially in the global north, have taken some, let's say, environmental issues into account, but none of them have like a separate environmental mandate. In any case, they could mostly easily, let's say, implement climate stress tests. But in any case, they do not discuss about green QE, green quantitative easing, or about decarbonized quantitative easing. This is not only because of the central bank mandates that does not take into account environmental issues, it's also because of market neutrality. So you might know that central banks in the global north do not want to affect the way that markets work. So if there is a specific proportion of bonds that are already bought, the central banks want to keep buying, let's say, the same percentage in order to avoid interacting with the market. I have done some work with Yanis Dafermos, Daniela Garbo, Adam Pavlov, and Frank van Leeuwen for the collateral framework of the ECB. So we have identified the bonds, the corporate bonds that have been issued and could be used as a collateral, and it can have been issued by carbon-intensive sectors such as fossil fuel companies or carbon-intensive transportation. And as you can see, the share of these bonds, percentage to total, is relatively high, despite the fact that the contribution of these carbon-intensive assets with respect to the gross value added is relatively small. So this is what we call a carbon bias. So despite the fact that this market neutrality contributes to a carbon bias, we don't have central banks being willing to change this. What about green financial policies? I'm sure you are familiar that we have a global financial system that is very powerful. They don't want to pay more. So obviously, when you ask them to implement a debt penalizing factor that I mentioned before, they would be opposed. And obviously, they have a power in order to avoid implementing this type of policy. Lastly, I would like to briefly talk about this changing consumption patterns that I mentioned. So far, it's not a very, let's say, attractive policy or initiative. One of the reasons might be because people that are rich, especially live in the global north, they're not willing to change their consumption patterns. They are not willing to change their own living of standards. Many thanks for listening to me, and I'm looking forward to the questions that you might have at the end. Thank you so much. I will stop sharing my screen now.
Thank you. There was actually one question already.
Okay.
But it was 15 minutes ago, or some minutes more.
You could have asked me. Sorry, I wasn't able to.
Yeah, and I didn't see it as well. Can you please explain again the difference between green subsidy and green public investment?
Yes, of course. So first of all, there are various green fiscal policies. I mentioned 3 of them: carbon taxes, green subsidies, and green public investment. When we talk about carbon taxes, obviously this has to do with the revenues that the government can collect when they ask firms to pay for their emissions. When we talk about green subsidies and green public investment, they are an expenditure for the government. Okay, so the green subsidies is when, for example, governments can give an amount of money to firms or households. Let me give you an example. So imagine that you want to have, let's say, on the top of your roof to collect energy. So in order to do that, you could take a subsidy from the government, so an amount of money that could finance, let's say, your expenditure. So this could be a green subsidy. The green public investment is something that the government does on its own. So it can, let's say, build electric buses. Okay, they can invest in low energy public sector buildings. So the government has already many public sector buildings. What can they do? They can make them more energy efficient. Okay, so they can invest in order to transform it. So that would be some examples of green public investment. So both of them affect the expenditure of the government. So the government needs either to collect taxes or to issue government bonds in order to finance them, but it affects in a different way, let's say, the economy. Thank you.
Thank you. Are there more questions? I don't see another one. So I will ask the question: Is your model already used in central banks or at the governmental level, or is it where, or what do you want that this model is supposed to do? Like, is it only for universities, or should it be like in the IPCC already?
Very good question. Usually what we do is try to put forward some models, some alternative models, in order to identify what they can do. So this is why we publish the work that we do. You need to take into account that policymakers, including the UK, the EU, usually use mainstream models in order to make their evaluations. So usually, even if they do not refer to environmental policies, they use DAG models mostly. So there is a lot of discussion whether these government, let's say, institutions or central banks could instead use alternative models like the one that I mentioned today, post-Keynesian ecological model. There is a lot of discussion in order to push, and in reality, you engage with them with a discussion. You identify, for example, that financial problems might arise. So there are some recent DHG models that have gradually taken into account the problems that might arise in the financial sector. So there is a change in the way through which modeling has been affected, and obviously then central banks will be affected as well. But nowadays, I think that we are a bit far of making central banks or government using the existing post-Keynesian ecological models. However, I must say that it might be a bit easier to induce governments or central banks to use this climate or this environmental perspective. So at the end of my lecture, I just show you a graph that refers to the collateral framework. This collateral framework, we have done similar work with Yanis Dafemos, Daniela Gabor, and Frank van der Ver. And this refers not only to the collateral framework, also to the quantitative easing. So there are central banks like the Bank of England, like the ECB, that have entered into such a discussion in order to take climate change issues. And to some extent, they have taken into account the discussion that I gave at the end of the lecture. So because there is a carbon bias, we need to take into account environmental issues, and we need to change a bit the quantitative easing program. So nowadays, the Bank of England has already announced that they are going to green their quantitative easing program. Of course, they still take into account the market neutrality. So there is a lot of room in order to make changes, but there is a lot of discussion about that. Okay, so overall, what I'm saying is that is a bit difficult to change immediately how policymakers make their decisions, but gradually there is some room in order to have discussion. And of course, there is a need for more work on post-Keynesian ecological models in order to support a little bit more.
Thank you. Does anyone else have a question so far? Okay. Okay. Then I will stop the lecture now here, and I want to thank you that you have been here with us.
Okay.
And yeah, we will stop the recording now, and